Not ready to pull the trigger yet, but let's find out what some of your high conviction ideas are, and we'll get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so you've got 3 international ideas for us. And the first one has already done quite well. It is Samsung. Talk to me about the dynamics, because in many ways, Samsung has kind of gone parabolic since the summer, thanks to
memory. And we're back to the AI trade. It is memory. It is the global AI trade here. Interesting. We were well ahead on the memory trade. So we own both Hynix and Samsung. So for those that are not familiar with the memory makers, with AI and everybody focusing on NVIDIA and the chips that need to, the GPUs that need to be very powerful, you need, if we think about transfer of information and what they call that latency, you need that, and there you need memory. So we had the emergence of HBM, high bandwidth memory. And basically that's dominated by 3 players, Hynix, Samsung, and then Micron in the US, with Hynix being the number 1 player. So we were overweight, but then and now I have to guess it was like the middle of last year, we started taking a contrarian view on Samsung and added even more weight to Samsung. Because
it was under pressure.
They were under pressure because they were falling behind. The irony is, right at the beginning of HBM, they were leading. And they were seriously falling behind. They struggled. At that time, it was the HBM3E. That was the latest, newest version. They struggled to get the certification from NVIDIA, which means that NVIDIA is fine with your product. You can start shipping. Whereas Hynix had none such problem. So the market started doubting that they can keep up with this race. And there were already some restructuring happening within Samsung, recognizing this problem. There was more restructuring later in the year on management to just try and get their technology advantage back, because they were always playing, we're so big, we've got this moat of being a massive company with big balance sheets. Now it is about how quickly and how fast can you develop and stay ahead. So in the meantime, so that's why we thought they will come back and they will get the certification. They surprised us. Not only did they get the certification, but then they said they're going to be the first on market with HBM4, which is new generation. And they just very recently announced they're going to start a mass production of HBM4. So they've moved from being a laggard to, I won't call them ahead of Hynix, but the pressure is now on Hynix because Hynix is also busy with their HBM4. But to come through with their HBM4 and show and prove that it's actually better.
And we've got a stock that's now up 260% over the past year. Still only trades at 8 times earnings.
Yes. And that's why we really, Hynix, we are concerned about valuation. But then one has to say, if you look at some of the other AI stocks that's working, but we are talking what's working, what's not working. But winners are trading at really expensive valuations. Not all of them, but a lot of them. And memory had currently been the focus for investors. So Samsung trading significantly cheaper. You could look at that from 2 perspectives. You could look at the total one, but it is a conglomerate. So it will be a conglomerate discount. The other way we love to look at it is to say, what if we break it down into components? And we say, on its chip making side, it's not exactly TSMC. It's good. It's a good second player, but it's not TSMC. So let's give that a big discount. Let's give it a discount on the phone side. Some would say, no, it should be the same as Apple, but we say, let's just be reasonable, give it a discount on its phone side. I think on TV, you can give it actually a little premium. And then you say, what if it can reach Hynix, which is a pure memory player, reach that valuation? Then if we start doing the sum, adding, sum everything together, we still add a significant, or we get to a significantly higher valuation. So we're talking 20-30% for us is quite doable. I think probably the biggest risk here is execution risk, because said they can do mass production HBM4. They saying they are going to come out with HBM4E in the second half of the year. Can they do that? When Hynix come out with their HBM4, is that a better memory chip than? And that will be the real question. So I think execution really important. Then there's a few other things that might work for them. They bring out probably this year the 3-fold Samsung. I think it's going to go the Galaxy Z. Maybe that helps.
That's not why we're buying the stock.
That's not why that would be for us like added bonus if that really takes off as a popular. But we're buying it for its memory side.
How long do you think the memory cycle lasts? I know that's a big question.
Yeah.
As they rush to produce, what's going to happen. At some point, it will be oversupplied.
Yes. I think at least for a number of years. But we're talking on the HBM side because it's basically
high bandwidth memory.
The high bandwidth, because the other side, NAND and DRAM, at the moment, so they have pricing power, but that part of the market, very, very cyclical. So yes, everything is working on the memory side. And we know that part can very easily, the moment if they expand capacity, because if you look DRAM, then you're suddenly not talking 3 players. You're talking a multitude of players. So, but the HBM side, we think that's really going to be the focus. And similar to a NVIDIA or a TSMC on the foundry side, that's going to remain a very important driver.
Okay, so, and you still see upside with Samsung. Let's talk about your second idea, which is Alibaba. And this one just has struggled. Other tech stocks have reclaimed their 2021 highs. Not Alibaba. It's definitely lifted over the last couple of years, but it's almost half of what it was since the pandemic. Why do you like Alibaba here?
Look, it's interesting that you're calling it a tech stock because that's actually why we like it now.
Okay,
It had turned into a tech stock. The majority, half of its business, or more than half of its business, is still the e-commerce business. And it struggles over the last number of years. Had been regulatory issues. They had a fintech side and they ran into problems there on the government side. The government clamped down on a lot of the e-commerce side.
We didn't see Jack Ma for a while.
Exactly. That all played into this falling out of favor with policymakers, which had been really important. And then they had their little cloud business carrying on, and they were trying to pump it up, but investors weren't overly interested.
And it's not like Amazon's little cloud business.
No.
Amazon is a dominant cloud player. Yeah. Alibaba, not so much.
And Amazon has AWS, and that's a very recognized part of Amazon now. It's e-commerce, AWS, cloud. But we must also remember that China is in the early stages of their AI development, cloud development. And that's the difference. We had the first shot over the bow with DeepSeek in January, February last year. And then it cooled down. And then the second half of the year, where we saw some of the applications, AI applications coming through, but then it became clear China has their own AI moment coming through. And with that, the cloud moment. And that's where Alibaba really comes through. It's a full stack, what we would call IaaS, so infrastructure as a service, a full stack provider. Nobody can really compete with them. I mean, it's Tencent. Tencent has stumbled a little bit on this now at the moment. So they are really the go-to if you're looking for a full stack infrastructure, AI, cloud provider. And that is growing very rapidly.
What kind of upside do you think? Does it go back to where it was during the pandemic, higher?
I think eventually it can go back to where it was because it's now the hope that the real growth is going to come from the cloud business, that it start looking eventually like an Amazon, where it's cloud and e-commerce rather than e-commerce with a little bit of cloud. How
much do you have to think about the risk that, what if it falls out of favor again on the part of the government, right? And they just, that's something that, who knows what could happen, but it could just as easily happen as it did a couple of years ago.
I think two things. One is the Jack Ma moment, that even if you're CEO, chairman of one of the most powerful companies, you still operate within a country. So you have to respect the country's framework. And I think companies have learned that. We've seen Tencent, and that must have been around 2017 that they've gone through that same moment. And then they learn to operate within the framework. And within the framework, they have then free reign within the framework. So I think that's the one part that they've learned how to play that. And I think personality-wise, we wouldn't have a senior official or a CEO really starting to criticize how behind policymakers and regulators are behind the curve.
So they understand. Okay, so you have two tech plays, Samsung and Alibaba. We're taking a little bit of a turn here with your third pick, Vista Energy. Talk to me about that.
Totally different Vista Energy. So in the energy world, it's not really a contrarian play, but there's a number of things that would kind of push it towards a special situation.
Is it oil and gas?
Oil and gas. It is actually shale oil in Argentina. So you can see the wrist holding the different things.
All my flags are going up.
Yes. What you have here is a company created in 2017. It's an Argentinian operator. The management came from YPF, which was and still is the big oil company in Argentina. But things that have changed. One, they were able to start unlocking the potential of shale gas and shale oil in Argentina, which they still have, they have massive reserves, but a very complex rock structure. So just lateral drilling didn't do it for them. And as in the US, they've developed vertical drilling and multi-stage vertical, they can literally follow the rock formation down. That unlocked the whole Vaca Muerta area in Argentina. So suddenly they were technically able to take the oil out. At the same time, over the last few years, or not the same time, a few years later, we had a political change in Argentina, where we get a government that are trying to bring, and I'm saying trying because that is another risk, trying to bring Argentina back on a stable footing from an economic perspective, but also from a policy perspective. So you take those two things together and you pick a pure player in Argentina, pure E&P energy player who had a few really good wells, but they're expanding very aggressively, really good operator, driving down cost if we think about well cost or even lifting cost.
Vista.
This is Vista. Mm-hmm. So very good execution, very, what's really sitting down with them and chatting also with them, they are very rational what growth looks like. It's not growth at every cost. We grow, we buy additional wells or we'll add new wells if we think we can get the productivity.
And they've done a few recent deals, big deals.
They've very recently done a fairly big deal. Mm-hmm. Again, a block just next to their own block. So again, they remain very concentrated. So for us, it's this that really excites us.
And what kind of crude is it? Like, is it refined locally?
It's the shale oil that gets shipped out. And that's part, again, with, if you think about some of the other players in Argentina, the oil players, a lot of their oil goes to the domestic market. Mm-hmm. For Vista, already 60% hits outside Argentina. Every additional barrel of oil for them goes outside, which means export pricing parity is basically they can
get better prices.
They can ask the international price. So that, and the one thing I do want to just also their efficiency of their wells. And this has to do with the cost of well, how quickly it can produce. We already see Vaca Muerta. If you take 3 months into it, their wells are more efficient than what we've seen in the US. And then on top of that, you have Vista.
And contrarian because of country risk?
A contrarian because of country risk, yes.
And did any of the Venezuela situation change their dynamics, their access, their competitiveness?
Not so much. I think longer term, it's more a question on where the oil price will settle. Mm-hmm. If we see Venezuelan oil coming into the global market, obviously that could pressure the oil price. So there is that risk. Now, at the same time, for Vista, their break-even rate is $45 a barrel. So it is still lower than even these prices that we're currently seeing. So they can continue to operate. But yes, the higher the oil price, the better for the company.
And just because they're growing via debt, they're growing via acquisition in part, is debt a problem? Or do you think it's manageable?
That's the other beautiful part
Yeah.
Of the company, is they have debt ratio of 1.36, so call it 1.4 times. For an E&P, very low debt ratio. From this point forward, they say they're going to be self-financed. So cash flow positive, going to repay debt, and then any expansion they expect to do that through own funding. So very clean balance sheet. Actually, one of their 3 pillars is a strong balance sheet going forward. They want to keep a strong balance sheet.
Matthew, it has been such a pleasure. I learned so much. Thank you so much for expanding our minds and our perspective just away from Canadian and U.S. stocks. I appreciate it.
Again, absolutely my pleasure.